Mr. Carlos, we have seen in UAE, UAE generally it's we call it as a hub of loans. Yeah, either you lend it or you get it. So in every balance sheet, you can see financial transactions, including corporate loans, personal loans, etc. So when you borrow, there are instances that you borrow at lesser price, or you borrow from your sister company or master company, parent company, subsidiaries, either at lesser price or lesser cost or zero cost. These are the instances which we normally observe in the balance sheets or financial statements of the companies in UAE. So having you said transfer pricing is a global subject, would this in any way impact the documentations and the procedures to be adopted for transfer pricing?
Absolutely, yes. In fact, the financing is one of the latest developments in the OECD guidelines of 2022.
Okay.
Just the recent release of January of 2022 of the OECD guidelines have a new chapter regarding the financing.
Financial transactions.
Although financial transactions have been always within the scope of transfer pricing, the issue is whether you have the borrower or the lender position. If you have the borrower position, your tax administration is not going to say anything if you have zero component of cost of interest, because that only increases the value of taxable base. So what they're looking for is basically the actual lender position. The lender position is if you have zero income imputed as interest, that is deemed to be requalified or recharacterized with the transfer pricing comparison. That is arm's length principle. This principle that leads us to say, if I would not be a related party, how much would I charge you as interest as an unrelated party? And that is to do with the risk, because it is also if it is a cross-border transaction, that risk might be the country risk, as well as the currency risk, as well as the on-payment risk. So all those are factored in the construction, so-called, of the actual interest rate that shall be imputable according to the guidance of the OECD. So basically, the importance of the interest is going to be more of a focus of the tax administration when you are the lender rather than the borrower. Although it should be applicable, it's only on the benefit of the tax administration that you are not taking this write-off, this expense out.
So if I'm at the receiver's side with a lesser cost, we don't need to worry about that. Yeah, it's the risk is more on the lender side. That's what you were trying to say.
In fact, although technically speaking it should be both ways, the regulations on income tax will always lead us to make adjustments when those adjustments are going to increase the taxable base. So if I am the borrower, if I do impute expenses, I'm going to be reducing the taxable base. So that's why it becomes irrelevant for the local tax administration. But the counterparty tax administration is going to be very interested on imputing the interest that my related party from abroad, for instance, is not charging me. So that leads us to a concept which is a very disruptive concept, so-called economical double tax, because that double taxation that is the result of economical reasons cannot be avoided with double tax treaties. The double tax treaties can only avoid legal double taxation, but not economical double taxation. So that's why in tax planning, we use the instruments of transfer pricing in order to avoid those situations where we have double tax situation because of economical reasons, and we just set policies that allow to overtake the deductions here and the imputable income there. So there is no double taxation on economical basis.
Now, if a company, you said that the lender is the person who will be the tax authorities will be looking at the lender mostly. Now, if the lender is giving to its related party, maybe, maybe for some imminent purpose, if the related party is having a cash crunch or they are having any liquidity issues, maybe they want to expand the business, maybe they are trying to take benefit of any synergistic formations with any other company. If for that purpose the loan is given, still that also will be looked into by the tax authorities. Is the purpose, by any purpose, will the tax authorities, okay, they will fine, they will exempt from looking into that loan aspect, or they will look into all any loan given to the related party?
Basically, that will depend very much on the local approach of the tax authorities, but according to the guidelines, is in every other case, because it can be the crunch of the availability of working capital can come from the unpayable of a related party sales.
Yeah, that's right.
So if I have a lot of receivables from my related parties, I might need extra cash. But the extra cash is only artificial, because if I would have received the payment from my related parties in the normal terms and conditions that a commercial sale would have taken place on an unrelated party, then I wouldn't have need to get the borrowing. Okay, so it's a very tricky situation. We have to go on a case-by-case basis again.
And Carlos, we have a case that say these are non-funded lendings, like including guarantees on guarantee favoring other entity. There is no funding. So would this is also falling under the transfer pricing definitions?
Absolutely, yes. After the last amendment of the OECD guidelines in January 2022, the guarantees become critical in order to impute a value to them. Again, it's an economical issue other than an accounting issue, because if there is no agreement on a payment or a recognition of the cost of giving such a guarantee, the likelihood of getting unpaid is high, maybe. In that very case, there is an imputable income to the one that is granting the guarantee, not the one that is receiving the guarantee. The one that is receiving the guarantee is exactly the same case as the one that is the borrower. But because I'm borrowing your guarantees, basically. So I'm not compensating you, I'm not taking a deductible expense. But if I'm the grantor of the guarantee, I am not charging you for that. I have to include an imputable amount for the guarantees granted to my related parties in order to be compensated and economically integrate that into my taxable base.
Do you foresee any major challenges for the tax authority, after the implementation of the transfer pricing regulations in the country?
Absolutely, for both. I mean, and for either one are different. According to our experience, basically, both as players in the system have different roles and different challenges. The main challenge for tax administration is to learn how to understand businesses' modules other than just making numbers out. Which is a major challenge, mainly when you have no statute of limitations, because basically that impose on the tax administration the necessity to get the knowledge of this new venture. And normally there is international aid from the OECD and several other worldwide organizations that provide training to tax authorities. But furthermore, for taxpayers is a whole new experience, mainly if those are local-based taxpayers that have had no exposure to transfer pricing in other jurisdictions. This is a major challenge, because at first you figure out that is something that is not related to you. I mean, that is only human nature. It's not that they're good or bad. It's that they just behave like, I wouldn't like this bad dream to be happening. But as each of its existing bad dreams, I mean, you don't pick, you don't choose to have that bad dream. You have it. And when
Already
the
you have
law,
it.
yes, when the law established this obligation, now you have to get started. Don't wait until you get tax authorities knocking in your door, because to prepare the documentation is a time consuming activity. And that time consuming activity normally doesn't fit the times that you will get granted by the tax administration in order to submit the documentation. So perhaps you will get 10 days from the tax administration to submit the transfer pricing documentation. All of a sudden, when you figure out how much does it take to get this transfer pricing documentation, is 30 to 45 days if you are very fast and if you have all the information gathered in a fashionable way. So basically, there is going to be a mismatch between the ability to perform things on a timely basis from the taxpayer viewpoint. So you'd rather do that in advance.
What do you recommend, Carlos, or rather, your advice for a smaller or a mid-sized company in UAE? Mostly what happens is, they do a practice, they follow a practice, but after some time they realize that this, is a mistaken practice. No one advised them properly. So eventually it ends up with some, dispute with the tax authorities, or they get huge penalties. So as a proactive approach, what do you recommend for a mid-sized client in UAE to avoid such, relationship with or to improve the relationship with the tax authorities in terms of transfer pricing readiness?
Yes, indeed. The question is very valid, because normally people think that if they are rather small, they're not going to be in the scope of the tax authorities, and it's the other way around. I mean, when you are too big, perhaps the tax authorities will have more time to come and really understand what the system is all about, but they will try first with the small ones. And this is something that can be improved by the rather small or medium sized entities by doing a lot of planning. The transfer pricing, setting of policies, setting of planning, and the good tax planning based upon the concept of compliance with the transfer pricing regulations is what we have found the most hygienic way to keep a relationship, a wise relationship with the tax authorities. It's always going to be disputable. I mean, there is no such a thing as an amicable relationship with the tax authorities. They have to play their role. We have to play our role. But what we have to be sure is that we are ready for any sort of questions in the audit procedure. And the best practices are to do tax planning, to do benchmark, to make sure that you have written policies in tax in your transfer pricing policies, as well as your tax planning well done. Because the other thing that the taxpayer must be aware of is that we are under an scrutiny of transparency. So there is no such a thing as a hide type of transaction. The interchange of information globally today includes around 197 countries automatically interchanging information. So such a thing as I'm doing this here and nobody will know, that is not longer the case. It used to be like that several years ago, but nowadays with the interchange of information, you'd rather be proactive rather than reactive.
So that prevention is better than cure.
Absolutely, always, always, always. And taxes is not exception.
So, Mr. Carlos, my final question maybe it's regarding now in Qatar and all, we have a limit on the basis of which, a certain limit, for example, 10 million Qatari riyal, they have set a limit of the value of related party transactions, and then over and above which, if it goes, then you have to comply with the transfer pricing regulations. Now, here the law is not out yet, but we believe that there can be, a limit can be put so that they don't want to bring 100% companies into into that transfer pricing tax base, but they will be keeping a value certain. Now, above that value, an entity, if they are coming under the transfer pricing regulation aspect, is it good or is it suggested that they have to have an in-house transfer pricing, a team or a specialist, or they outsource it to more experienced consulting firm where they have a good tax team and transfer pricing experts?
In the adoption of the new regulations, what is going to be very scarce are experts. They're not going to be experts. I mean, people is going to start learning as they go. So it's very important that those experts normally you will find in existing firms that are dedicated to that activity of advisory in the compliance with transfer pricing. And furthermore, you have to bear in mind that even those thresholds are challenged normally by the group analysis. So if you want to just split into a grouping that don't put you in the radar, I mean, that is the wrong equation. I mean, you are going to be in the bushing, you are going to end up being lookout, and that might be perceived even as a fraudulent activity. Therefore, it's good that companies over time get people that becomes well versed on transfer pricing, but it's very difficult that they're going to be able even to find an expert that will be in an in-house expert. Even the global multinationals do not have access to a team of experts in their own departments.
They are outsourcing.
They normally outsource, and if they do have a team, they always do outsource of what we call a 4I analysis, which is like auditing the work that
done
is
by the
being
in-house
done by the inside people, because the view of the world is by far broader when you are an advisor, a third party. Is like an auditor that has the independence to just not being that close to the day-to-day operation. And furthermore, one of the things that always is advisable, the use of the third-party provider, is the cost of the database. The database that you need in order to go and make your benchmark analysis is heavily costly. Therefore, it's not well worth it for a entity that is going to just use that database for its own consumption, basically to just go and make that investment that is not only huge, but it's going to be only used once in a year. So it's going to be very, very little yield out of that expense. So, but normally what we recommend is to use experts, let the experts teach people within the organizations, because it's a cultural change. When you have an adoption not only of corporate income tax, but the adoption of transfer pricing hand to it, is a cultural change that is dramatic, and you are really in the middle of a turbulent market. And I guess that this is going to be fun, but it's going to be very challenging for you as an advisor. So I wish you all the best, and wish all the business community all the best, because it's going to be a challenging, turbulent time.
And also, Mr. Carlos, to adding on to your explanation, there is a rumor now that in UAE that all this analysis can be done by a software instead of a manual intervention, and then do economic functional benchmarking. So have you seen anywhere that a software can take care of the whole TP side?
There are softwares that organize the information, but the analysis in itself is a human act. We have, in our practice, we do worldwide services for transfer pricing, and such a thing as an automated mechanism of obtaining from here the data and the output is a TP documentation, such a thing doesn't exist. What normal software would do is have an organized, organized type of analysis, basically just like a taxonomy of the TP documentation, but not a write-up of what the TP justification is all about, because it's a brainful work, very deep analysis of multi-discipline type of analysis. It's not only financial, it's not only legal, it's not only economical, it's the melt of all that knowledge. Such a software doesn't exist.
Now, these applications, you said that there's a one-time cost. It's big amount. Do they have yearly cost, recurring cost?
It's a recurring big amount.
It's a recurring cost, not a one-time.
A recurring big amount. It's the same amount every year, or more.
Okay.
It's more of subscription.
It's a subscription type. Yes. Because you have to be updating the data in order to have the comparables that roll up year to year.
Okay, thank you so much, Mr. Carlos, for your valuable information to us.
You're
Definitely, it's going to be the best information for our clients. And thank you so much once again for coming and supporting us.
Thank you.
Thank you.
All the best.
Thank you, Mr. Carlos. Thank you.
Thank you.
Bye-bye.
Thank you. Thank you.
Thank you.